Well, welcome everybody. Thank you for attending this morning's session with WCM. I'm Andrew Aitken, the head of distribution for Contango. Perhaps you're familiar with me. I'll be hosting today's session. With me is Jon Tringale. It says Paul Black in the corner. Unfortunately, Paul Black has come down very ill with the flu over there, and we thought he may appear next to Jon, but unfortunately he just can't. And so we apologise for that. But Jon is a portfolio manager in the WCM team. We're very familiar with him, and we're privileged to have him being involved. So welcome, Jon.
Good to be here. Thank you.
Before we start, I've just got to go through a bit of housekeeping, as people know. A message from our compliance team. Firstly, this is a live and interactive session, so we'd love to hear from you. If you have any questions you'd like us to address, please submit them via the question box in the control panel on your screen. We'll endeavour to get to those questions towards the end of this half-an-hour session. Please be aware that this session will also be recorded. Secondly, this webinar is for educational purposes and of a general nature only. It does not constitute personal advice. It must not be acted on or relied on. This webinar is not an offer, recommendation, or solicitation. I also just want to say we have we're expecting about 300 on this webinar today. It's a very diverse group of investors. WCM is very well known in Australia, and we understand that your needs are diverse as well. We have a two-man team in our Sydney office that will take 60 phone calls a day if need be. If you have specific questions that you want and specific needs in regards to what you want to know about WCM and your investment portfolio, please call us. We'll return your call. Send us an email. We'll return your email. So just please understand that we're doing this for catering to 300 people, and it may not be as specific as you want it, but we will definitely get back to you as soon as we can if you have a question around that. So I thought probably to start, I think we all know this has been a very challenging time, and for WCM and quality growth managers, it's obviously been a very challenging time. I've had 30 years in the markets, and I've seen this a number of times, and it never feels great. It may be one of the first times inflation's been mentioned over that period, as much as it has been, Jon. So it's been that challenging period. Last year, we had a webinar with your chairman, Kurt Winrich, and a colleague of Paul Black's for 35 years. And the question was asked, what is the type of period where you guys are most likely to underperform? Obviously, people have had a great experience with you over the last 5, 7, 10 years, of course, but it's never nice during these periods. His response was inflation, interest rates rising, exactly this type of period. So I know that we probably expected it, but the macro analysis side from WCM has never been a big part of what you do, Jon. But what do you think are the main factors that have been driving this market at present?
Yeah, well, it's a host of factors driving the market at present, none of which seem to be related to company fundamentals. I mean, it's a whole host of various macro factors, many of which are intertwined, right? It's inflation. It's certainly, I think, above all else, been the U.S. Federal Reserve's response. And the more hawkish tone they took in January, how we've seen that continue. That by far is moving markets more than anything else in our view. And then you couple in some of the rising geopolitical tensions. You couple in kind of the war in Russia and Ukraine. And you have kind of a host of other macro things I haven't even mentioned that are also kind of in the mix. But it's all macro in nature, and I think a good proof point of that, when we look at our portfolio and how the underlying businesses are performing, they're performing very, very well. In the first quarter of the year, going through the entire portfolio's earnings releases, we had 37 holdings at the time, 34 of the companies, so over 90%, met or beat earnings expectations. Now you could say earnings are backward looking and the markets are very forward looking, which is true. So I will add that all 34 of those companies maintained or even raised their forward guidance for the rest of the year. So we've seen really compelling results in aggregate, over 20% earnings growth for the portfolio, and yet you look at how the portfolio has performed year to date and it's down significantly. So all of that has come really through multiple compression. And I think you could argue that maybe some multiple compression is warranted. Parts of the market where maybe, our markets in general, you could argue in hindsight, were pretty frothy. But then again, in a backdrop of zero interest rates, maybe that made some sense. But the just how dramatically things have corrected, has really caught our attention and is creating some pretty interesting opportunities in the market today.
Yeah, and I think that's the frustrating part. The underlying stocks are performing well. These companies haven't changed just because of some of these macro backdrops. But it's, I suppose, from an investor's point of view, it's hard to watch that unit price or that share price go down. Going back to your experience, I know you've been around for a long time, Jon. How's this different to other downturns that you've seen?
This one's interesting in that it's not a drawdown in the markets because of, macro weakness. To the contrary, you've seen generally pretty strong economies around the globe, rebounding from COVID. So we've seen, very tight labor markets. We've seen wage inflation. We've seen, as I mentioned in our portfolio, a lot of companies really thriving, and yet we're looking at a market that's down significantly. So it's unusual in that the causes of this down market, we just haven't seen inflation of this magnitude for a whole handful of decades. Coupled with, we've had the taper tantrum. We've had some, periods where we've seen, rates go up in a short period of time. But this one, I think, at least the market is pricing in, is going to be, kind of much more drawn out and much more severe than we've seen in a very long period of time. So it's really these kind of extraneous factors affecting asset prices, not kind of an economic weakness kind of led drawdown. So it's interesting. You go back to COVID, which was, we had a pretty strong economy generally entering the pandemic. So you had that as kind of a very unusual case for markets to go down. Of course, they've rebounded tremendously. And then you have kind of what's happened this year around rates and inflation, and what's been, by most measures, a pretty healthy economy. So, it's a bit unusual, but at the same time, we've seen similar environments like this before. I think in our world, if you go back to the end of 2016, in terms of what was working and not working in the market, it was almost identical. Leading up to and following Donald Trump's election on November 8th of 2016, you had energy up double digits, commodities and materials up meaningfully, and you also had financials up strongly. Every other sector was down big. You had value beat growth by over 1,000 basis points, low quality smashed high quality. So I could tell you all those things and you could say, geez, it sounds like 2022 year to date. So it's been an almost just mirror image of that environment, different factors. That was an environment that we struggled late 2016, and we came back very strong, 17, 18, 19, 20, 21. So, who knows, this time is a little bit different because of the forces there, but we've seen these environments. We're certainly not panicking. We're certainly re-underwriting the theses for all the businesses we own. And importantly, we're looking to take advantage of this volatility. It's not just our portfolio under pressure. It's a lot of names on our watch list are down, tremendously in 6 months off, no news, or in some cases, good news. And so these are the types of environments where we can pick off some great businesses. And for that reason, that's why you've seen us a bit more active with our trading this year.
Yeah, and that patience and that ability to be able to buy after there's been a market capitulation or market weakness is so important. We talk about that a lot. I suppose from our point of view, it's been interesting watching how some of our clients react, and certainly in that institutional market in particular, there's more inquiry at this moment as they sort of realise maybe this is the time to re-weight. But once again, that's hard. For more frustrating if you're looking at your own personal unit price or share price as it goes down. We understand that. If we turn a little bit to the portfolio, a lot to the portfolio, that performance has been hurt obviously by so in this quality growth portfolio. What have been the major detractors from the performance during the period so far?
Yeah, it's been really a perfect storm of headwinds for us and our approach, which again, we expect to encounter from time to time. I think the magnitude this year and the timing, I don't think you can ever predict these things, but really everything has gone against us. I think that some of the biggest detractors, we own no energy or commodities. Those have been far and away, the place to be this year. Apart from that, there hasn't been a lot of places to hide. So we've had no exposure to these best performing sectors. Then you look at the sectors that tend to be target rich environments for what we look for: growing competitive advantages, strong, adaptable, well aligned cultures, going after addressable markets that are large and expanding, which give companies the opportunity for very durable growth. Areas like tech, healthcare, niche industrials, consumer, those have just been obliterated this year. So our overweight to tech and selection in tech has hurt us. Our overweight to healthcare has certainly hurt us. There's a pocket of healthcare of businesses that I think were perceived to be kind of COVID winners that had exposure or perceived exposure to COVID tests, COVID vaccines that benefited certainly from a lot of growth and revenues that aren't going to be very durable in nature. We've known that. We haven't underwritten COVID-related revenues continuing for these companies. They've been very clear with investors, communicating and breaking out separately what are kind of maybe the one-time COVID benefits. But I think nonetheless, you've still seen a bit of an unwinding of those perceived COVID winners in healthcare have really derated a lot. So we smell some opportunity there, but it's been a challenge for us. And then I think just purely from a style perspective, right? Value has been the place to be, lower quality, and those are areas that we're just not going to own. So it's been, feels like we've been taking blows from all angles year to date.
Yeah. And the managers that maybe have had good performance, that they've been invested in sectors, I suppose, that we've traditionally not invested in. And it's also really important for our clients when we speak to them. They want to know what are we going to do? What are we likely to do in any in their portfolio? There's a reason that we're in their portfolio in the position that we are. Yeah. But you look at, say, energy and material stocks where we've been traditionally very light on. Do you ever see a situation where perhaps we start buying some of these stocks and sort of upweight our energy and material certainly energy stocks in our portfolio?
Yeah, so as I've mentioned, we've been through plenty of periods. We've been doing global equities for almost 20 years now, and we've experienced 05, 6, 7. When you had that big energy boom, we've experienced other periods where we've had more shorter term bursts that energy has done well. So we know that's just part of economic cycles. Supply and demand ebb and flow, and those imbalances reach different points that are good and bad for energy prices. We don't think we have a crystal ball or any magical skill to accurately predict the spot price of oil. Frankly, we don't think anyone can get that right consistently. So for that reason, we prefer to stay in our circle of competence. We feel like we have a real edge, understanding competitive advantage change, understanding culture, a lot of these qualitative parts of businesses that tend to get overlooked. That's where we're going to stay and play, because that's where we feel like we can have an edge. And that's also the types of businesses we feel like will really deliver great results over long periods of time, which is how we're aligned. We're very much long-term investors. We don't try and bet on short-term cyclical phenomenon, which again, when you get it right, you can look really smart, but you can get humbled very quickly. So I think especially in light of how well energy and materials have already done, to kind of flip and go chase that stuff now, certainly wouldn't be consistent with kind of who we are or what we do. So that's not of interest. I will say historically we have owned over the last 14 years. There have been 2 instances where we've owned companies that were technically in the energy sector, but these were really more technology companies that had fit our criteria of a growing moat and were more kind of a picks and shovels, if you've heard us use that term, approach to play something like that. So there could be a very unique business model that was much kind of higher quality and actually fit our framework that happened to be in energy. That's possible, but it's not something we're certainly looking for.
And listen, since the last time we spoke, the world's opened up. Even Australia allowing you guys in, which is amazing. So, and we know that 2 or 3 of you are coming down actually in the next month. We'll be road showing across the country. So anybody that's listening here, if you do want to meet with team members, absolutely will be in most states. So how's that affected you guys? Obviously, getting out and meeting those companies, you've got a rich history of global and international stock picking. You're based in Laguna Beach. That reopening, have you got out there? Is there been tangible benefits from that, Jon?
Yeah, we've we've been just thrilled to be able to get out and travel and see companies again this year. We've had a couple of tours, I'll call them, meeting with CEOs. We had one kind of here on the West Coast. We had one where we were going around the United States, and we've got upcoming trips planned to Latin America, Europe. Asia, parts of Asia are still pretty tough to get to, just with COVID. So, but yeah, no, it's been really great to get back in front of these companies again. You can do Zooms and maybe get a lot of the way there, but we like to be on campus. We like to be at the headquarters. We like to talk with the head of R&D. We like to talk with the CEO's secretary. There's just a lot of things you can pick up by physically being somewhere, and the types of questions we ask and so on. I just think there's something that you're missing when you're not able to do that. So that's kind of coming back in full swing here.
Yeah, great. And then that sort of leads me into, we know share prices in your preferred sectors and preferred stocks have come off. Can you give us a few examples of what you're looking at, perhaps names that have recently been added that you can get a bit granular with?
Yeah, so we try and use the mantra around here of take what the market gives us. We want to be contrarian at times, and I think when you look at what is the market giving us today, what's been the hardest hit part of the market, certainly some of the higher growth parts of tech, and some of that is for good reason. I think there's a lot of companies that became story stocks and got way ahead of themselves and probably are years away from making any real money, which I think is fair to scrutinize those business models. At the same time, there are some what we think are very well established, very sticky, big enterprise customers that they're very well entrenched and have a long runway for growth that do make money, that have been basically thrown out with the bathwater with that other group of companies. So we've added 4 enterprise software, enterprise tech companies to the portfolio this year. This is a part of the market we've seen businesses we've liked for a few years and haven't bought anything because frankly, everything's been, we thought, overpriced. And some of these names are down, 70% in 6 months. A couple recent purchases in the portfolio were Snowflake and Datadog. These are both companies that have IPO'd within the last couple of years or so. They're a little bit different, but both really play on this cloud migration, but dominate different niches. In the case of Snowflake, in terms of data storage in the cloud and actually, crunching that data. There's tremendous complexity to the IT infrastructure and tech stack needed to do that well. Snowflake has recruited the best engineers from the last kind of 30, 40 years in the industry and built an all-star team and unbelievable product. And they've got a big first mover advantage and kind of are unmatched with their product, which is something that is growing on enterprise IT budget lines. Just given where how the world has shifted, that's one that's off huge. We've recently added, as well as a company called Datadog, which is the global leader in observability, which is basically a fancy way of saying giving chief technology officers, giving IT professionals a dashboard view of how the company's entire tech stack is performing from the infrastructure to the customer-facing, website and mobile applications. If something breaks, being able to quickly identify the problem and fix it and get it back online faster. This is something that's excuse me, really growing in relevance, just given workflows are moving, companies are engaging with their employees and customers in different ways, given kind of this hybrid world we're living in and so on. So again, that's a category that's growing. There's tremendous switching costs. They've got a best-in-breed product growing very rapidly. And again, I think we've intentionally tried to shift our technology exposure over the last year or so away from some of the big COVID winners and e-commerce and digital payments, and shift to more enterprise tech, where again you're less reliant on consumers. It can be a bit fickle. You have more visibility into spending because of enterprise IT budgets. And again, I don't think anyone will argue that technology is becoming less relevant in workplaces today. So those are just a couple of examples where we've tried to be a bit opportunistic here very recently.
And if you had a few stocks in the portfolio, especially over the last 5 months, ones that have disappointed you, well, perhaps we could have done something different there. Maybe we should have looked at not having it in the portfolio or at a different weighting. Do you have any examples of that, John, that you might be able to share?
One name I feel like we got snake bit a bit by was Wuxi Biologics, which we sold in the first quarter. That was a pretty short hold for us. We owned it for just a little over a year. The leading contract development and manufacturing organization in China basically manufactures medicines for emerging biotech and established pharmaceutical companies on a global basis. Extremely dominant in China, 80% market share. We're all familiar with how that country is just pouring money into the local drug development ecosystem so they can become less reliant on the West. And there's no signs of any slowdown there. And this is the company really that is capturing that in we think, a very predictable, visible way. But they also have about half of their revenues from US and Western European companies. Which I think on one hand shows you how great their offering is, that the Mercks and Pfizers and Dow Jones type of companies will use them to manufacture medicines. But at the same time, as political tensions have increased between the US and China, increasingly healthcare and kind of under the guise of patient data security is becoming more of a battleground. And I think we just see potential risk that the U.S. could make it harder for companies here to do business with a Wuxi. And if that ultimately ends up impacting their business, that's not priced into the stock, and there could be a lot more downside. So that was one where, I don't know ex ante how you could have known that. We knew there was going to be some geopolitical risk, but that's one that's been a mistake, and we've moved on from. We've had other companies. Probably the most struggling company has been Shopify, which thankfully we've trimmed 7 times. So we even trimmed it early this year before first quarter earnings. So it's a 1% position today. We've again taken 700 or 800 basis points off of it, as it has done well. But that's one where we've just seen growth in e-commerce as a category. They're still outgrowing Amazon. They're still outgrowing everyone else. They're still gaining market share, but there's some challenges just in. I think the market got too excited about e-commerce growth extrapolating into the future, where we've seen it kind of pull back to the trend line, and that's in a high growth name like that kind of rocked the share price a bit. But again, we've managed that position size, so it hasn't done us a whole lot of harm. But that's one that's been a little disappointing year to date.
Sure, and just a few questions coming through, John. One that I know you'll be able to answer straight away. Cash holdings in the portfolio. Just remind us, when you don't take large positions in cash, it's not an asset allocation decision that you feel is yours. If you're buying new stocks or want to buy new stocks, how do you go about doing it?
Yeah, so we consistently keep less than 5% cash, maybe 2 to 4% is average. So, that's enough to, if we want to buy something, we have some dry powder to go take a 2 or 3% position. But more commonly, one name in, one name out is typically what happens. So if we identify something we want to buy, usually we're selling something simultaneously. So we'll kind of make that swap. But we do have, again, typically 2-3% ready to deploy.
Yeah, most of the mandates in Australia allow 5 and 6% cash at maximum down here. Once again, we believe that the cash position is the client's total portfolio decision, not ours to make. We're a global growth manager and we'll invest in global growth stocks, so you know what you're getting. The other question that's come through, probably you've got this question a bit. The Ukraine, of course, obviously hit us early February or during February, and has been quite a debacle in many ways for global markets and obviously the personal cost. Russian stocks in these portfolios, you've had very few.
Zero. Yeah, we were fortunate. Zero Russian stocks to start the year. Zero today. We haven't owned anything based in Russia in this portfolio in a bunch of years, and that would have been Yandex quite a few years ago.
Yeah, I think we can call that very few. Zero. And listen, apart from that, that's pretty much where we're going to leave it today, John. Thank you very much for your time. We did promise clients it'll be a half an hour session. As I say, we're very keen to keep in front of clients and to answer your questions. We have a team waiting that's happy to take phone calls or emails or any questions come through. We will have the WCM team are committed to the Australian market. We're going to be coming down in the next 2 to 3 weeks. WCM will be in Australia. Obviously, there's also a small cap portfolio and a mid cap portfolio. John, do you have any? The mid cap portfolio is being introduced to Australia very soon. That is quite unique in that it's ex-US. Do you have a general feeling in regards to what that market's like at the moment, the opportunities you're seeing there?
Yeah, I think if anything, some of those smaller mid cap names have been under more pressure this year. So again, I think it's all consistent with what I've shared today, but maybe even just a little bit more so, given the smaller cap names haven't been as resilient.
Yeah, and we'll be doing further webinars on that later. It's not for today. John, thank you for your time. I know Paul sent his apologies. I hope he gets better. He will get better, and we will be doing one of these with Paul very soon. John, thanks for stepping in short notice. It's always enjoyable speaking to you, and we'll be seeing you very soon, hopefully on these shores.
All right. Well, thanks, Andrew, and thanks everyone for dialing in. Cheers.
Thank you.